What if I told you the stock market isn't just being moved by traders, hedge funds, or big banks, but by artificial intelligence? Sounds like sci-fi, right? Except it's 2025, and it's already happening. AI isn't just helping investors, it's rewriting the rules of finance. From ChatGPT being used for stock research, to next-gen quant funds steering billions, to brand new asset classes literally born from algorithms. The game has changed. So stick with me, because today we're breaking down how AI is reshaping the markets, the opportunities it's creating, and the ticking risks hiding under the hood. AI is no longer coming, it's here. Across industries, it's everywhere. The global AI market is worth about $391 billion right now, and projected to explode past $1.8 trillion by 2030. And on Wall Street? Same story. AI isn't a tool in the corner. It's baked into risk models, trading systems, portfolio strategies, even brand new assets. Take quant funds. 10 years ago, most people didn't even know what they were. Today, they dominate equity flows. Searches for quant funds are up over 1,100% in just 5 years. But here's the real twist. The new wave isn't just number crunching. This is Quant 2.0, self-learning models that read news articles, earnings calls, tweets, and even satellite images. And they don't just analyze, they adapt in real time. That's not trading. That's Skynet with a Bloomberg terminal. So how is AI actually changing the stock market? Let's start with the quants. Traditionally, quant funds were all about structured data. Things like stock prices, trading volumes, and profit margins. But what we're seeing now in 2025 is what many call Quant 2.0. These models don't just crunch numbers. They're pulling in unstructured data too. Headlines, Fed speeches, social sentiment, satellite photos of Walmart parking lots. If there's data, it's in the model. The crazy part? These AIs keep learning. They'll scrap a strategy mid-flight if conditions change. Some studies even show advanced reinforcement learning models outperforming old benchmarks, mostly because they know when not to trade. Of course, there's a catch. These models can break down if the world suddenly changes in ways they weren't trained for, which makes them fragile during black swan events. Now, while quants are getting smarter, AI isn't just helping the big funds. Everyday analysts and even retail investors are plugging AI into their workflow. ChatGPT-style tools can summarize earnings transcripts, pull insights from regulatory filings, and surface risks faster than a junior analyst chugging Red Bull. Limitations? Sure, they don't have real-time feeds yet. You can't tell ChatGPT, "Yo, should I short Tesla right now?" and expect magic. But finance-specific platforms are bridging that gap, combining LLMs with live market data. Translation: the robots aren't just working for billion-dollar hedge funds. They're slowly sneaking into your brokerage app. And here's where things get even more futuristic. Some experts believe that in the next stage, it won't just be companies or ETFs that get traded. The assets themselves could be datasets, predictive models, or even algorithmic agents. Yes. Imagine buying stock in a trading bot itself. The algorithms become the asset. We're inching toward a market where prediction engines are financial products. If that doesn't blow your mind a little, I don't know what will. On top of that, AI is already proving it can react to information at a speed humans just can't match. Think about parsing an earnings call, an SEC filing, or a breaking news headline. An AI can read and interpret that in milliseconds and generate a trading signal instantly. That same power can also be used for things like fraud detection and flagging anomalies before they blow up into major risks. And finally, we can't talk about AI in finance without mentioning the massive arms race happening behind the scenes. These models are hungry. They need enormous computing power, lightning-fast networks, and endless streams of clean data. Firms that invest heavily in that infrastructure are building an advantage that's hard to catch up to. NVIDIA, for example, is right at the center of this. Its chips and partnerships are powering a lot of the AI trading operations we're seeing today. So with all of this unfolding, the question becomes, what does it actually look like in the real world? Well, we don't have to guess, because AI is already leaving fingerprints all over the market. One of the clearest examples came out of Stanford, where researchers tested an AI analyst that made adjustments to human-managed portfolios. The results were eye-opening. The AI-assisted portfolios outperformed the humans over several quarters, showing just how powerful these systems can be. In Brazil, a project called AlphaX has been testing an AI-based value investing strategy. Instead of relying only on classic technical indicators, AlphaX blends them with machine learning. And the simulations so far suggest it can generate stronger results than traditional approaches. And then, in early 2025, the release of a Chinese AI model called DeepSeek actually shook the global markets. The hype around its capabilities was so intense that it triggered a sell-off in Nvidia and other AI-heavy stocks, proving that AI innovation, or even just the perception of it, can cause immediate ripples in investor behavior. And of course, we can't ignore the broader trend. Quant funds now dominate a huge share of equity flows. That shift didn't happen overnight, and it's not slowing down. It's a direct sign that AI isn't just part of the market anymore. It's steering the market. All of this makes one thing clear. AI in finance isn't future talk. It's here, it's active, and it's shaping real capital flows right now. But of course, with all this power comes some pretty serious risks. The first is that AI models can be deceivingly good in backtests, but fall apart in the real world. They might look brilliant on paper, but once the market shifts into a new regime, especially during a crisis, they can fail dramatically. There's also the possibility that we're living through an AI-driven bubble. Some analysts are already comparing the current hype to the dot-com era, pointing out that valuations for many AI-linked stocks are stretched to levels we haven't seen in decades. If history is any guide, that kind of euphoria doesn't last forever. Another issue is transparency. Many of these systems are black boxes. Even the engineers who build them don't always know why a model made a certain call. Regulators are starting to demand more explainability, but the truth is, most machine learning systems aren't built to give human-level reasoning. Then there's the risk of the herd effect. If too many AI systems are trained on similar data, they can end up making the same decisions at the same time. That creates crowding, which can spiral into flash crashes or systemic breakdowns. Ethics and manipulation are another concern. These models are only as good as the data they're fed, and data can be biased, or worse, intentionally manipulated. Imagine an AI that reads fake headlines or spoofed signals and trades on them instantly. That's a recipe for chaos. And finally, there's the issue of access. The firms with the deepest pockets are pouring billions into infrastructure, GPUs, and proprietary datasets. That creates a kind of moat, where the biggest players get stronger, while smaller firms and retail traders are left on the outside looking in. So, while AI is pushing finance into a new era, it's also introducing vulnerabilities we've never had to deal with before. Which brings us to the big question. How can you, as an investor or traders, actually navigate this new AI-driven market? The first thing is not to treat AI like some magic black box that's going to solve everything for you. It works best as a tool to surface ideas, highlight risks, and run scenarios. But it still needs human judgment on top. It also helps to think about diversification in a new way. AI systems tend to do well when the environment looks like what they've seen before, but markets don't always play by those rules. Building strategies that can survive the unexpected is more important than ever. And don't underestimate the role of data. A lot of people focus on the models, but the quality and source of your data often matter more than the algorithm itself. If the inputs are flawed or biased, the outputs will be too. For most individual investors, building a full AI stack isn't realistic, but you can still take advantage of the tools that are out there. Many platforms now offer AI-driven signals or analytics that you can plug into your process without needing your own data center. At the same time, it's worth paying attention to the regulatory side. Governments are moving toward demanding more transparency and accountability from AI systems, and that's going to shape the tools you use and the companies you invest in. And finally, keep an open mind about what counts as an asset. In the years ahead, it may not just be stocks or bonds on the table, but predictive data sets, algorithmic agents, or new AI-linked financial products. All of this means AI is no longer just a trend to watch. It's part of the investing landscape now. The question isn't whether it's here to stay, but how you'll position yourself as it keeps evolving. AI is rewriting the stock market in 2025, not as a fringe trend, but as infrastructure. We're witnessing quant funds getting smarter, AI tools democratizing research, and new asset classes emerging. But the terrain is risky, uneven, and fast-moving. So, tell us, what scares you most about AI in finance, or what excites you? Tell us in the comment section below. Also, if you found this useful, hit like, subscribe, and ring the notification bell. More deep dives coming soon.